Well, good morning, good afternoon, or good evening, depending on your perspective on the world. Welcome to Trading Coach's Playbook. My name is Brandon Wendell. I'll be your host for about the next hour. We're going to take kind of a high-level view or overview of the markets, and I'll answer any questions you might have as well about the markets themselves or technical analysis or anything related to that. Kind of what we do here at Wealth Builders HQ, things like that. So welcome everyone. And before we get started, just need to remind you that we are not broker-dealers or investment advisors. So we're going to look at all this information, look at markets from an educational standpoint. I am not telling you to buy, sell, or hold anything in particular, or give any personalized recommendations about the markets. All markets do involve risk of loss. This is always a situation. We can try to minimize the risk, but we can never eliminate it. And we're also not subject to trading restrictions. So we can have a position in a market or initiate one at any time. So good afternoon, Kevin. Welcome, Stephen, Jennifer, Julio, Brenda, everyone. Appreciate you being here. So we stay pretty busy here throughout the week at Wealth Builders HQ. A lot of programs going on. The main one that I'm involved in on a regular basis is down in the bottom corner there, the E-mini think tank. And if you're wondering what that is, basically what we do is we look at the futures markets on a regular basis, Monday, Wednesday, and Thursday for 2 hours. And it's kind of like a live trading room where we go into the live markets and identify opportunities and find out how we can take advantage of those. Usually I started off with a PowerPoint with a bunch of different trade ideas, educational ideas. And, we're basically trying to build consistency in our futures trading. And so far it's been very, very successful as far as building that consistency. We take a look that was December. The E-mini think tank, that was December's numbers. And, not everyone's a winner. I had 9 winners, 5 losers. But the key thing is that the winners are much bigger than the losers. And let's see, I missed it. I had January's results, actually, because obviously we're in the middle of January right now. And Kevin says, E-mini think tank is the bomb. Thank you. Appreciate that. You can see we plan out a lot of trades, but not all of them get taken, unfortunately. We got a lot of no entries. That's the NE. A few of them are still pending, like soy oil and MES. That's the nice thing is you could trade the micros if you didn't want to trade the full-size contract. Excuse me. So that way you can kind of adjust or minimize your risk as well by using certain markets and certain securities rather than using the regular full securities. So let's see. Is this today a full trading day? I think it is today. I know we're closed on Monday, but I don't think we're having anything different for today as far as I know. You can check. What is the minimum capital requirement to take all the trades? It varies. I mean, the margin could be, like I said, if you use micros instead of full-size contracts, it could be very, very small. Like if I go over here to my TOS Thinkorswim and we take a look at ES, for instance, right there, and I go to futures, I'm going to zoom in on this. There we go. You can see that margin requirement, that's the overnight margin. Intraday is going to be slightly different than overnight. But if we were to look at the ES, it shows, 12,980. But then if you go down to MES, which is the micro, that's only 12,988 overnight. And obviously you have less risk, less reward, things like that. So the day trading rates, depending on where you go, could be as little as $100 a contract for the margin. And the commissions are obviously relatively low as well. So you just got to kind of shop around to see. But if you're looking at all the trades, again, not all of them are overnight trades. Not all of them are even entered. So for instance, in the month of January, let's see, entry 1-3 out of 1-5, 1-4, 1-4. So this would have had maybe on the 4th of January, would have had 3 different securities open: the Aussie, Nat Gas, and wheat, Kansas City wheat. And this was a day trade for 2 of those. But again, you would have been open on that one already. So if you had the Aussie and then you added Nat Gas and wheat, let's take a look. Starting off with the Aussie, the overnight would have been $1,600. Adding in Nat Gas, overnight, which we didn't do. It was a day trade, 6,550, right? That was a day trade. Yeah, in and out on the same day, hit a trailing stop. So the margin would have been less. Maybe $500. Let's call it that. So now we're at about 1,650. And the last one was Kansas City wheat, which is 2640. Again, that was exited during the day. So you might have had to put up another few $100s. So you could have taken all those trades on the 4th and been in all those for as little as about maybe $2,500 max. Might even be less than that. If you held them all overnight or wanted to make sure you had enough margin for overnight, you probably would have been okay with about $7,000 or $8,000. So, I do the stats based on one contract per target, and I usually have two targets, and then I give possible returns based on a $15,000 account or a $50,000 account, which is usually enough to do all the trades if you wanted to. And then I actually have the annual returns from the program. And we did pretty well last year. Our average number of wins for 2023 was 20, almost 21 per month, and number of losses at about 13 per month. I'm rounding up. But the average win was more than twice the average loss in size, and our win rate was better than 50%. It was a 62 on average for the year. And we earned on average 18,000 per month. You see the yearly total and the average rate of return per trade. So yeah, you could have taken every single trade most likely with the minimum capital of about $15,000 in the trading account using margin on the intraday, and then maybe might have needed 20, 25, possibly higher, depending if you had certain overnight, like the NASDAQ, where it has a higher margin, or you could use micro again. And you can see it's consistent. The year before, same thing. We had a little bit better win rate, 71%, and win-loss ratio was still almost 2-1. And then 2021, it's just been the same overall, right around 70% win rate, again, keeping about a 2-1 reward to risk on average. So, it's all about building consistency. I started in 2020 with this program, and even then, still pretty consistent. This was almost 3-1. So, yeah, I'm pretty proud of that. And we haven't had a losing month in all those months and all that time. It's just finding the right opportunities, using strategies that are very consistent. And it's the same strategies that I use on higher time frames as well. So I said we were going to kind of look at the overall market today. And of course, if anybody has questions or things they want to look at, just let me know. Are the majority of the P&L from swings or day trading? It's kind of mixed. I haven't broken it down, to be honest with you. This was an overnight trade, day trade, day trade, day trade, day trade, day trade. Definitely overnight, it's still open. And two more day trades. So there was only two overnights, and wait a minute. How many trades? 5, 1, 2, 3. Yeah, so we had 5. We had 8 trades altogether. 2 of them were overnights. So that's it. So can we look at Alibaba long? Yeah, we can, absolutely. I'm going to go ahead and look at the overall equity markets typically, but looking at Alibaba on a weekly chart, this looks like a dead stock. I mean, we may get a little bounce coming up soon, and the reason why I say that is this bearish momentum that we've been experiencing for a long period of time is, it's not really pulling. I'm sorry, I thought it was divergence. It's not. It's just getting a little slower on the bearish momentum. And it looks like there's earnings coming up on the stock as well, and it might be too late. Yeah, 31st. We're getting kind of close to those earnings. The reason why I was saying that is there are some strategies I work part-time with a brokerage, and I'm writing some educational material for them. And we're going to be releasing some of that educational stuff coming up. And I'm actually doing a webinar for them coming up as well. It's TradeStation, if anybody wonders. And one of the things I was looking at is an opportunity based on earnings, doing an option trade, basically, which is straddles, but people usually do it at the wrong time. So it's also too close to the earnings to really do it at this point now anyway. But let me maximize this real quick, bring in Alibaba and change the settings and add in this in basic. Whoops, that's not what I wanted to enlarge. I'm going to do that. There we go. Yeah, you can see that earnings are coming up pretty soon, but we already have very high volatility. So it's not an opportunity right now. But I like to take advantage of volatility. And like I said, in my workshop that I'm going to be doing coming up as well, when volatility is expected to rise like it does for earnings, you see how the volatility went up before the earnings announcement. And if you go back to previous earnings announcements, I'm sorry, that was a dividend, I think, wasn't it? always forget which symbol. Yeah, that's a dividend. These are the earnings, but same thing. Going into earnings, you get that rally, and it gives you an opportunity to take advantage and profit from that volatility increasing. So I'm not going to explain how to do it right now, but I will do it in my workshop, and I'll also do it in some of my courses as well, obviously. So I can't really take the time to do it right now, though. Anyway, looking at Alibaba as a stock itself, doesn't look like it's got anywhere to really go, to be honest with you. Even on the earnings announcement, we've got rally base, not really a great supply zone here. I don't see anything wonderful. You got to be careful with these too, because this is an ADR, I believe, right? The stock Alibaba is not a US based company. Doesn't show as an ADR. Does it show it on my other platform? Yeah, ADR. See right there? That's American Depository Receipt. Basically, you're not actually buying a stock when you trade that. You're buying a receipt for stocks that are traded on another country's exchange. So you have ADR and ADS. Okay. Yes, Paul, a straddle is buying an at the money call and a put, but not 30 days of expiration. No, you don't want to do that. Okay, you got to be careful when you buy them and what you're buying, because if you buy with less than 30 days left, time decay will eat up most of your profits. So it's better to pay a little bit more money. Like I said, I'll be doing a workshop coming up. You can check it out on the company's website later. And I'm also going to be doing a lot of, actually, I'll do a more than 30 days. Yes, absolutely. Maybe I'll do a workshop here for Wealth Builders HQ as well, based on it, since we're getting so much interest on it. So I'll put that together and let you guys know when that's happening. Do a special options strategy session, perhaps. So anyway, getting back to the stock, I don't really see much on it. It may go up a little bit, but I think 75 is going to be kind of a ceiling there on a longer time view. 240, yeah, still not seeing anything. But what I was warning about with the ADR, you can see how many gaps we get on the stock. And the reason why, even if it's on Arsenal, thanks. Jay says, I'm interested in any workshop I have, even if it's on Arsenal. That's my football team that I love. Not doing so great right now, though. But anyway, getting back to the gaps, the reason why the gaps are happening is because as an ADR, this is trading on the Chinese markets, and then the US markets have to catch up to where it was overnight. So that's why you got to be careful with these. There's a lot of gaps on those types of securities. And, if you go out to FinViz, they have a map of the market, so you can click on, and it loads default the S&P 500. But if I go over here to world for my filter, now it's showing me, oops, sorry, Lucy, she got excited there. Basically, it shows you US stocks that are based in foreign countries or traded in those foreign countries. So if we zoom in a little bit, if it lets me, there we go. We can go over to China, and there's Alibaba. So if you wanted to invest in other countries, this is one way of looking at what are available for you in the US market. So these are tradable in the US, but companies might be in Taiwan, South Africa, India, Switzerland, Netherlands, and so on. But the main thing I brought this up for is if things are in our same hemisphere or same time zone as New York, they're probably not going to gap as much. But when you're dealing with countries and companies like Denmark that are plus, I don't know if that's +6 from the East Coast or +5. It's probably +6. I think they're on CET. Anyway, you're going to get gaps because they're trading overnight. And when we open up, the stock has to catch up, or the ADR, ADS has to catch up with the original stock. But yeah, this looks like it's kind of stuck. You can see right now we're at the top of this range between 73 and 71 and turning down a little bit because we didn't have enough momentum to break out. If we pull back, I would say the 71.80 right here might be the pullback point before we bounce, but we're going to stuck at about 875 anyway. And Tesla was the other one that had a request on it. What did I do here? TSLA, not Tisnea Life Sciences. And big picture, weekly, let me go and clean this up. Look at that. We're making lower highs every time we try to rally, and we're losing momentum. So on the weekly chart, and we got earnings coming up as well on this one, right? I used to monitor the Nifty 50. Yeah. What's significance of that related to those gaps? Same thing. If you trade stocks that are listed here in the US but are from other countries, you might also get gaps. Like, was it Infosys, Tata? Can't remember what else there is. Several of those. Anyway, we have earnings coming up on the 24th pretty soon here for Tesla. Overall, still looking bearish. Lower highs, lower lows on the weekly. You got weekly demand down here. Clean that up. That's not right, quite right. That's a little better for the zone. Drop base rally. And yeah, we're still holding up and not collapsing because we haven't gone below 40. But if those earnings take the weekly RSI below 40, that's a bearish sign. And we should be able to break down into the 160 area very, very quickly. Looking down to the daily time frame, again, looking very bearish. You broke these prior lows and you see we did go below 40. And notice what happens. Oops, as soon as we go below 40 here, right there, we're at 40, kind of on the cusp. And as soon as we start breaking below 40, we get the gap down and much bigger moves down because that's a signal right there. The markets are extremely weak. The nice thing is that securities usually give warnings before they do that. You just have to know how to find those warnings. And the warning was, hey, we came up to the origin of this selling pressure and we had what's called a negative divergence right there. Prices were going up without the momentum needed to break through the zone or continue the upward trend. So right there, when you made that lower high and lower low on the 29th of December, that confirmed the divergence and that prices were going to go down. So, this isn't catching the top of the market necessarily, but if you identified you were at supply, that would have been a better, actually, that's not even the zone, I realized. I think this is, but it doesn't matter. It was a second touch divergence, and there's a collapse. So you could have gotten out at 248. That's the confirmation right there, roughly 250 for the confirmation to short. But the shorting best entry would have been at the retest of the supply, although I wouldn't have taken it because it's a second test. I personally wouldn't have taken that trade. So, yeah, conservatively, you could have entered right here when that candle was forming as it was breaking the prior low and confirmed the negative divergence. And at this point, our nearest daily demand is right here. Drop base rally. We do have enough momentum to break through that, but we should pause first. If we do pause and try to rally at all, I don't see us moving up much more. Oops, did that wrong. This is a possible zone right here, drop base drop at 231. So that might be another shorting entry point. And I would say the next downside target is above 186. And then 159. So yeah, I'm expecting the price to basically do this. Maybe run into that little bit of demand, bounce. And it won't go straight like this. It'll be choppy, but that's kind of the move I'm expecting. And then after it completes that first move, might bounce a little bit more. Because remember, the trend is pretty bearish still. And then move down to the second area of demand. So that's kind of what I'm seeing. This is Tesla. Yeah, somebody asked about Tesla. So I'm going to go to the big markets, though, overall, and take a look at those. Obviously, this is one of the fuel or drivers of the NASDAQ. So we can take a look at the NASDAQ as well, which actually is a pretty good index to look at. Let me go ahead and show you why. When it comes to indexes, you're very welcome. And I don't know why this changed on me. It's weird. There we go. First of all, I want to check to see, because I forgot to mark the actual date of the impulse that we're in right now. So going back to the NASDAQ, looking at I'll go to weekly. Looks like we came off the low right there on the 23rd of October on the weekly. Yeah, October 23rd. And I also can look at the daily, which, kind of have an upward move right now from January 5th. But the reason why I wanted to focus on that for a moment was, What did I just do? I use a comparison chart to see who is actually leading the markets and who's lagging. So it was right around the 23rd of October, or that week, I believe. Really, it looks kind of like Friday was the bottom. And what I do is I compare them to see which market is our leading market, because that leading market will usually tell us what the other markets are going to be doing. So the leader leads, the laggards follow. Nope, that's not what I wanted. I wanted that. So you can see that on the large caps, the NASDAQ is the leader. The Russell is the leader if you include the small caps as well, though. And again, going back to a daily chart, that was daily. I was looking at the weekly first, but actually I should do that again with the weekly. Make sure I have the right one. Yeah, I was right. Same thing. NASDAQ is the second most. It's the leader of the large caps, but not all the indices. And I was saying that we have kind of a move to the upside going on right now from January. And you can see that NASDAQ was the leader. You see, is this from the beginning of the month? Right there. NASDAQ is still the leader. So the NASDAQ's been the market dragging everything upwards. The other equity markets are just kind of following. So when the leader gives up, then the laggards will typically fall. So starting with the analysis on the NASDAQ is not a bad thing, because that is the leader telling us how high we're going to go. And when it caps out with a supply zone or just loses momentum, that's where the other markets will turn around. And it's been doing that over and over and over again. If you take a look back historically here on previous rallies, right here, there's your warning sign. And again, it's another divergence. You know, one of the cool things, I didn't log in, but I wanted to show you, one of the cool things about the E-mini think tank program is there's a lot of education involved in it as well. I created a lot of educational videos and self-paced education to help to improve trading in general. And we had the link that was there earlier. We'll put it up again if you're interested in joining. We do monthly or quarterly subscriptions. And as soon as I get into this, member section. Sorry, it's a little warm and humid here today. Just had to turn the AC down a little more. I'm sure everybody's like, yeah, whatever, because it's probably cold in most parts of the country. But where I am in South Florida, it is 80 degrees out right now and humid. Anyway, here, E-mini Think Tank. When I click on that, you'll see all the education that's involved in it. That's there for you if you join. So we got class recordings from the sessions we do, but right there, bonus videos. And I've done educational pieces on lots of things: Elliott wave, seasonality, scalping, how to find trends, my RSI, and my 889 strategy. So pretty much everything I do, I detailed in here is opportunities for you to figure out what's going on in the markets. And there's documents that accompany that. So like how I'm using the RSI as a momentum indicator, that's all detailed there as well. It's kind of neat. Feels like 15 below zero in Minnesota. Yeah, I believe that. I've been in Minnesota when it was negative 11 before. Not something I really want to repeat, but I've been there many times. It's cold. So right here, we have a divergence on the indicator. It tells us we're going down. And then the downtrend was confirmed. We had lower highs, lower lows, and eventually couldn't get below 40. And when you can't get below 40, that means we're still bullish. And sure enough, the trend rallied back up. So what's going on now and what might be going on for 2024, right? That's going to be the big question. Well, currently we're stalling out. And the question is it done retracing? You know, is the market done pulling back, and are we recovering? And remember, this is the leading market. So, well, we've rallied up, started to pull back, and I didn't see if this was actually a retracement value. Kind of looks like it might be a 38.2. Nope, 23.6. First retracement, which means a very weak retracement. That suggests a very strong bullish trend. And the only way we're going to be able to continue going up, we have to break this prior high on the weekly chart of the NASDAQ at 17,165. But at the same time, we also need the momentum to be higher. If the momentum on the RSI reads lower than what we did on the previous peak, even if prices try to go above this prior high, they will fail and we will pull back. And it could be a false breakout that leads us downward. But as the price moves up, which it's kind of failing right now, it's not really getting the momentum it needs. But if prices continue to rally, it won't finish today, but maybe next week, if we can go above this high from end of December, okay, and if the RSI also goes above the prior high from December, then legitimately we'll break out, and our next target is way up at 18,000. Then you go up to 19 and 19, almost 20,000. Okay. So let's see. I think it's changing. Well, it depends on what you do as far as trading. You can also email. We could take that offline, Robbie or Robbie. Sorry, not sure how to pronounce it, but you can talk to Amelia if you want, or you can email at support@Wealth Builders HQ, and we can kind of talk a little more about what it is you're looking for and get you into the right program. Roby, okay, thank you. So anyway, let's go a little bit smaller time frame now on the daily and see if we can pick out some details that might tell us more about what's happening. So the SPX, I'll go to that next, but that'll actually be following whatever happens here in the NASDAQ anyway. So looking a little more in the NASDAQ here, you can see high, lower high. And once again, before we turn down, let me clean this up again. Before we turned to the downside, again, we were warned. I love it that the market tells you what it wants to do before it does it. It doesn't always give you a huge time frame warning before it happens, but it's giving you enough of a warning that you can take action. So right here, you see lower high on the indicator is not backing up the higher high. This is what I was talking about. If we break out again, we need more momentum, not less. So once this candle formed on the 29th of December, basically it opened, tried to rally, failed. And as soon as it broke the low of the prior candle, that confirmed this divergence and warned you of that drop. Okay. Now on the drop, we did not go below bearish territory, which would have been 40. And here we are rallying again. So we are above 60 on the RSI. Had we failed to get up there on this move up, we would have a big move down. So what this is currently telling me is we're moving sideways, obviously, for the last 2 days, real choppy. But we do have bullish momentum, at least on the daily chart. So if we are to break down, we're not going to go below this right around 16.5. If we pull back, our first move down will not be below that 16,500 level. Okay. If we break up, again, we want to see more momentum pick up as we start to move to the upside, and that would defer to the weekly again. So if we're able to break above this 17,165, we'd have to have more momentum than we had on that previous peak for it to continue. Otherwise, we're most likely going to go a bit sideways, or as I said, down, bounce, and down again. And it could be a very bearish first quarter. The next downside target, the immediate target, would be right here, just under 16,000, basically. So what I'm looking for, at least for the next several weeks, about 2 or 3 weeks, is, as I was saying, if we start to push down, we're not going to go down too far. We get a bounce, and that's going to be kind of the critical watch point, because when we bounce, if we do that, if the RSI can't get above 60, okay, 40 and 60 are my overbought, oversold. It's a little different than what you see on most RSIs. And again, if you want to know why I'm using those numbers, I have a whole lesson on it and how I actually use it in detail. No, yeah, I would use that size. I have it in detail in the E-mini think tank. So overbought is 60, oversold is 40. Anyway, if we can't break above 60 on that bounce, that's kind of the signal right there that's going to be a great shorting opportunity down in the 15,908 area. And the prices should then go below 40. And now we continue the downtrend. We just have a small bounce. And when you bounce, usually bounce up to the breakout point right here, or a breakdown point. before we go to the next level. And honestly, this isn't great right in here. So the next level would be down here. But without a doubt, we're going to get a little pause here in that 15,300 area. So this is a possibility in the near term future. Takes us out, again, for the first quarter, probably right around March. Or, if we go sideways, we could just go sideways and a bit choppy. But if we can get a breakout again above 60 on the RSI on the daily, and of course on the weekly, we make that higher high, then we go to the upside and those, 18,000 the targets there. So looking at the SPX, you can see this is almost doing the exact same thing. I got to be careful with this index chart because I use this for one of my programs. I'll actually use the S&P futures. They're the same. I use that for intraday opportunities on the weeklies. We sell options on the weeklies in another program I do called SPX Cash Flow Secrets. So anyway, it's pretty much the same picture here. This looks a bit weaker than the S&P does, doesn't it? Notice we have the peaks and we're definitely dropping off in momentum as well. And, you could use other indicators if you chose to. I just use the RSI because I'm familiar with it and I know it works very well for this purpose. But if you were to look at something like fast stochastics or slow stochastics, is this it? Yep, that's right. You'll also see those same divergences and possible sell and buy signals as well. You got to be careful with the indicators and using them for sell and buy signals because typically the signals are late. For instance, we had the same divergence I mentioned on the stochastics right here. And right here, there was a sell signal kind of in the middle right there. It actually happened on this candle. And you would have noticed it on the formation of the next candle, both the divergence and the crossing of those two lines giving you a sell signal. And that's still pretty timely, right? So you just got to know how to read it all. But what happens with the SPX is pretty much the same as what's going on with the NASDAQ. This is the daily chart, and the weekly would look very similar. We have less momentum than we had before. So right now, we're just kind of retesting these prior highs, but we don't have the momentum to break out because we need to be bigger in bullish momentum than we were before. So same thing, we have a possible push to the downside and could take us down into about 45.60 if that happens, but it's going to be choppy along the way. Pretty similar to what we just experienced with the, there it is, the NASDAQ. You get a little push back down, but we're not going to make a fresh low as we move down because we had too much bullish momentum left over. Then we get followed up with a pullback before prices ultimately break down. A little rally-based drop right there. Or sorry, rally-based rally demand. That 4,600 area. And then the next area, got a little bit right here before we go down to 4,100 if it gets really bearish this year. So obviously, if the momentum turns to the upside and picks up, we need to break the high at 48.41 with more momentum than we had before. If we don't, it's a false breakout. We'll come back. But if we do get the momentum we need, then we don't pull back. Overall S&P target is 5133 and 5400. So I was actually on my friend Merlin's little podcast show the other day, and they asked me my prediction for the S&P by the end of the year, and I said 5400. So we'll see if that's actually going to happen, because I'd like it to be bullish for everybody in their 401ks, retirement accounts, get really good returns. However, we just don't know. So there's a possibility of us turning to the downside. We could still get up to 5,400, even if with the turn to the downside. Again, it comes down to that momentum and continuation. And yes, I can definitely move on to the dollar index. That's a great one to do. Most people would like the markets to rally. Yeah, obviously, right? Tied to their retirement and their wealth. So I'm looking at the dollar index, which is a major player because it's going to be influencing the bond prices and bond yields. It's going to be influencing commodities and commodity prices. So looking at the dollar index, notice most of them move in opposite directions than the dollar index. As a matter of fact, um, go here in that site. Oops, I think that's the right one. Make sure that link works. Yep. It changes over to PHP, but you type it in with the HTM at the end. This is a free website. It's part of MRCI. MRCI is a paid service for futures trading and seasonality and spreads and stuff that I do. I use it quite heavily. But um, by the way, if you end up signing up for them, I'm not saying you have to, but if you decided you wanted to sign up for MRCI, you can get a 10% discount by dropping my name, basically. So you go to, where's it here? Purchase subscriptions, and you click on MRCI online subscription. And it's, I think, yeah, $379 a year right now. But if you go and you put in as a new customer, how'd you hear about us? You just say Wealth, Brandon. So for Wealth Builders HQ and my name, and they'll give you a 10% discount on the annual subscription. So it becomes $341 a year. Sorry, $341 a year. Anyway, that's only if you need it. I'm not saying you need it. There's a lot of tools on there about seasonality and spread trading, as well as seasonality of individual futures. So you can check it out. There's a 2-week trial there too. But the reason why I brought you to this part, this page is free. You can get in by using that link I just put out. It shows us correlations. So I'll use this column, which is the US dollar, and we can see, notice all the negatives there? Well, working across, the first one is the Dow. The Dow and the dollar go against each other 40% of the time. Actually, it's probably easier to do this right here, this row. There. And in that row, the negative numbers are showing that they move inverse of each other. So for instance, the 30-year bond and the US dollar go against each other 90% of the time over the last 180 days. You can see all the bonds are extremely negative. 10-year, treasuries, Swissy, euro, British pound. That goes without saying, they should move opposite. And securities that are basically traded in the dollar currency should also be pretty negative. The further away from zero you are, the stronger the inverse or positive relationships are. So the US dollar and copper move against each other 80% of the time. So you can see the dollar influences a lot of other securities. So looking at the dollar is a very good thing. And we are looking here at the weekly chart. We did go into bearish territory. And we fell down off the highs, making lower highs, lower lows. And so far, I'm not seeing any sign of recovery. What we're going to look for the dollar to bottom out is pretty much what we saw last time the dollar dropped like this. Had this big collapse in the US dollar, and what finally gave signals that it was bottoming out and done with the move is a positive divergence. Price moving down, indicator not really following. It did move down a little bit, but not as much as it should have. And then it's a little late, but going above 60, that's signaling the change in a bullish trend. So right now, we have a bearish move. We are trying to pull back a little bit. And what we're going to look for on this next potential move down, if we break the prior lows, we also need to do it on the indicator. If for whatever reason prices end up reaching this prior low, but we make a higher low on the indicator, right there, making a higher low on the indicator, even though we're making lower low in price, that would be a positive divergence, and that would be signaling that the bottom is in and we're getting ready to rally. So that's what I'll look for before I can say, we are possibly turning around. Another signal that would also come in is maybe we don't make another low. Maybe we make a little higher low in price. And the RSI, oops, if the RSI stays above 40, that's also a sign that prices are turning around. So that's what I'm going to be looking for on the US dollar. If we start to come down again and try to make another low, but we can't get below 40, or we get a positive divergence, we're going to bounce. If we don't, if we get more momentum, then we just keep going. And the next demand zone on the index weekly is 99,126. So we take this down to the daily time frame for the US dollar. Oops, that run button, sorry. And again, you see bearishness right now. We had a little divergence earlier here, but it just made us go sideways and then we dropped to new lows. So currently it looks kind of like we're just going sideways, kind of almost like a flag. We had a fast move up off this low, pretty much went sideways for a little bit here. Now, the more you go sideways, the more likely you are to continue the move that you were in prior to entering the sideways move. That means we should continue higher. And actually, our next stall point would be right there at 103.63. I can probably put on the dollar futures to look at those as well. This is just the index itself. But if the dollar goes up in value, that means that other securities inversely related, like bond prices and commodities, should go down, right? So we would expect them to move in the opposite direction typically. So we still have to wait to see if we can break out. And the other thing I would look to see, look at that, we're stalling out at 50. We need to get above 60 to maintain that bullish momentum. Otherwise, it could fall back at any time. That'd be your next target up there. Zones are real clean and easy to see. We can even go smaller time frame, maybe 4 hour, and try to look a little bit more, but there's not much here right now. We're just going sideways, stuck without momentum. So like I said, when you see the momentum pick up, and then we can start thinking about breakouts. So since I was talking about commodities, I can move over to things like crude oil and gold or treasuries and start taking a look at those as well. And let's see. Looking at crude oil, I think we're still on this contract. I better make sure. I use bar chart quite a bit. It's free and there's good information there. My friend John Rowland works there. And basically, if I go to futures and futures market overview, it's on this tab right here. You see futures market overview under futures. You can actually see the volumes and get an idea of what is the front month contract. And the reason why I wanted to check that is we're getting closer to rollover. You can see right now, crude oil has almost 300,000 contracts traded on the February contract and about 150,000 on the March. So it's getting bigger. We've actually rolled right here on heating oil, 44.9 versus 39.6, March to February. So once you get higher volume on the new contract, right there, March rather than February for gasoline, we have rolled over. That means we want to trade that new contract. You always want to trade the contract with the most volume. So on nat gas and crude oil, it is still February contract for the front month. If you are trading heating oil or gasoline, you should be trading the March contract. You can still trade the other month. It's just not as good typically. Price moves won't be as good. The spread won't be as good. So as example, oops, wrong page. I can do it here. It doesn't matter. We take a look at HOG 24. That's heating oil. Looks okay on the higher time frames. You go down to, let's say, a 5-minute chart. And this one's not that bad because it still has decent volume. But some securities, if you choose the wrong one, the charts won't look as good. You'll get gaps because there's not as much trading volume on it. So Yeah, that's 1 minute on heating oil March. Let me see if there's any difference on February. No, not yet. I can do the same thing with gasoline. There's still pretty decent volume on this, but yes, notice how there's some intraday gaps now. Shouldn't be seeing those. And if I change this to the March contract, which is the actual front month contract, more volume, the gaps are still there. Sometimes they'll go away when it happens, but it didn't in this case. Anyway, going all the way back to crude oil, we're still on the February contract and it's getting ready to roll up. There's the roll date. As a matter of fact, contract expiration coming up on the 22nd, which means we should be rolling pretty quick. You usually get a notification from your broker. I don't know if I have it being shown on these. Now, if I go out to, it usually goes to my email, actually, I think. But depending on which brokers you're trading on, you'll actually get notifications. So let me see if this opens up the message center. Yet, well, in a moment, I'll come back to that. Anyway, as far as direction for crude oil, we're stuck sideways. And while I'm thinking about it, that's one of the other things we can also do. MRCI.com is one of the good things I can use MRCI for. So I'm going to log into my account here and see what is the typical move for this time of month or this time of year for these securities. Right here, we can go to futures seasonal patterns on MRCI. And we were looking at the indices. So real quick, we'll take a look at, say, the E-mini S&P 500 for the March contract. And it'll tell me historically what has been the chart pattern. You got the last 26, 15, and 5 years. And we zoom in a little bit more. Last 5 years from January 2023, where are we here? Mid-Jan. There's a little bit of a bearish move, and then it picks up to the upside at the very end of January going into February. Before mid-February, we get a collapse. That's been the overall pattern for the last 5 years. So I think that's kind of what I showed too on the NASDAQ, where we might have to pull back and rally and pull but a drop. Let's take a look over here as well. Yeah, let me go say April. Okay, so yeah, that's kind of the pattern we're expecting, perhaps, for the S&P. Right now, we're in that area where the markets are likely to decline for a little bit before we can rally up. And let me get rid of the other longer terms for a moment. Just focus on this one. Like I said, there's today, January 11th, but that's from last year. And the 5-year history from last year is we're about to enter into about a week and a half long decline. Let's see if it's the same on the NASDAQ. Remember, that was the leading index. Now, these are just suggestions because just because it's seasonal pattern doesn't mean it's always going to happen. Okay. With technical analysis, everything always happens except for when it doesn't. So looks like the last 5 years diverged a little bit from the older ones, 27 years in the pink, but right here in the last 5 years, yeah, January 12th. Actually, today's 12th. What did I say it was 11? Today's 12th. Anyway, we usually start a decline until the end of January before we rally to about the 15th of February and then drop off again into March. So that's the expectation for the markets on the equities. Looking at crude oil now. There it is, crude oil. And we can do the individual contracts. We are rolling into the March contract soon, so I'll just do that. Or we can even use the index as well. And this is much more volatile, it looks like, obviously. A little more choppy there. And well, it looks like we should be a little bullish in crude oil. It's the 12th. The last 5 years has really been different than the previous 15 or 30 years. Last 30 years, just mildly bullish right there. But in the last 15 years, there's a peak on January 17th and a decline, just like the equity markets, until the end of the month. However, the last 5 years, you can see it's been exaggerated on the move up. So crude oil is potentially bullish right now until January 20th, and it drops February 3rd, and then it rallies. Now, this is just an overall approximation of what's likely to happen based on what happened in the past. Doesn't mean it is going to happen. Let's see the dollar index if we have that too. Yep, dollar index. I can just go to the index again. Well, the attacks of Yemen were this year. It wouldn't have been influencing the past. This is looking at the historical pattern. So unless there were attacks every single year about the same time, that's not explaining what happened in the past. But right here on the US dollar, actually looks like January 12th is a bottom before the markets tend to rally. Last 30 years in the pink. Today, the 12th, has kicked off an average return or average run to the upside. Oh, oil rises when that sort of thing happens. Absolutely. Whenever there's uneasy or unrest, is what I meant to say, in the Middle East. Yeah, there's an influence on oil prices, obviously. Yeah, and that can change some of the seasonal patterns too when you have those interruptions or things that happen, socioeconomic events. Anyway, we should expect the US dollar to be rallying for a bit, which again should put pressure on the commodity prices. And in the last 5 years, hasn't had as much of an effect. The rally hasn't come until February. So we'll have to see. Maybe that little rally is a little delayed as well. So those are just some of the tools I use on MRCI. And now I got TradeStation open finally. Did some work there, but what I wanted to show you was the alert center. A lot of people forget that's even there. You got to go down to your little computer notification area. Basically, I opened up right there, a little up arrow, and I found it, TradeStation Message Center. It comes on when you log into your platform. And it's very important because it tells you, right here, alerts. You should have got some order notices soon. But what it tells me is, first notice date for some of these securities, that was the January contracts, is Friday, December 29th, 2023. They're physically deliverable. You have to get out of your positions, either roll them or offset them by the 27th of December. And if you didn't do it, it will get automatically sold off and your account gets restricted, meaning you can't open new positions for 90 days. You don't mess around. So make sure you pay attention to notifications. You usually see pop-ups on some programs. Some programs will send you emails. TradeStation has the notice center that you got to pay attention to. So there's a lot of different tools out there to notify you that something's happening. But be aware of the rollovers and when markets are closing up for trading and rolling to different contracts. So right now on the weekly chart, we're just dead in the water sideways. We should be expecting a bit of a bullish move, but it might not happen until end of the month. We came into weekly demand and died off for the most part. So continuing on with crude oil here on the daily chart, we tried to push up, but we have no momentum right now. So there's really just nothing here as far as trade opportunities in the bigger picture. Now, this will not continue long term. And, so historically, crude oil tends to rise a little bit in the spring. So we'll see if that's going to continue to be the pattern for this year. But so far, we've got nothing. We got to see the momentum pick up and get some trend, because really since mid-December, we haven't gone anywhere. What is CBX doing? Take a look at Chevron. That's an old line. That's not doing much either. Tried to rally up and then got caught again and pulled back. But didn't make a new low. See why. That's not really a divergence. Prices are kind of moving down there. Same here. I noticed there was weakness. There's divergence right there. Price made a higher high, could not do it on the indicator, and we came down. But because we had too much bullish momentum, we started coming down. We had to bounce before we made a new low. If this rally doesn't get above 60 on the RSI, then we're just going to continue to push down. As a matter of fact, we retraced 38.2%. So it depends on where we retrace to finally and start breaking down. If we stall out at this particular Fibonacci retracement, then what I would expect is continuation. We actually did this in the E-mini think tank on Thursday when we had our live session on the Russell 2000. Caught a nice little trade on that. I'll show you how. But this is all I did is I used Fibonacci's. Yeah, the way I do it is based on the Fibonacci levels. And let me show you what I did in the E-mini think tank class, because this is kind of cool. We did this, and you can see the fibs are still there. So what happened was, and this was on the intraday opportunity, 15-minute time frame, I think. So intraday, oops, there we go. I was trying to figure out how to trade these because the market, especially the Russell, it hadn't really given us great trading opportunities first thing in the morning. And what happened here, just lights out of the way for a moment, was we opened up, and I'm sorry, it wasn't even opened yet. This was the news release. That was the CPI numbers, I think it was on the 11th. And you can see the reaction we had. Little push to the upside, collapse. And then we retraced. Here was the open of the market at 9:30. And there were two possible entries there. One was an entry, which is pretty aggressive. And I think I took that one, which is basically we opened up and we broke down through this 38.2% retracement. And I took a short here. As a matter of fact, you can see it right there, 1974. There was, well, that's the average price. There were actually a couple different trades. So 1975.5 and then 1971. So the first trade was done as we were breaking down. It took two contracts. The second one was entered as we broke below this 1972.2. I got in. So the different ways you could trade this, one would have been to sell short at this first fib number, place your stop loss either one at ATR above, or what, which is one average true range above, or just at the next Fibonacci level. The second contract or second entry was as we broke down through the next level. So I was actually waiting and seeing it move down. It did on this candle and came back, unfortunately. So I was waiting for it to break down and place my stop one ATR above. Unfortunately, that one got stopped out, but then we ended up dropping anyway. And then I ended up hitting target one, and the retracement on got pulled out for the target two, or not target two, but stop loss, trailing stop. So I made profits basically, but that's it. I traded it based on the Fibonacci levels. And then the targets were also fib levels. Obviously, I look back to see demand as well, but yeah, he when he does that. There we go. You can see we had a couple of targets down below for projections. So that's kind of the same thing that we're seeing right now, right here on crude. Sorry, Chevron, not crude, is that you could sell short at one of the levels, place your stop loss at the next level, or wait to see it actually breaking down and continuing the impulse down, which would be shorting here at 146.36, stop loss at 147.76, and then target the projections to the downside. So that's what I see there. Anyway, I got to get running. It's already 1 o'clock. I didn't realize what time it was. So hopefully, it gave you some good information about what's going on there and some of the markets that are out there. I would love to have you join me in the E-mini think tank if you're interested to learn more about all this stuff. I've got my techniques and strategies, how to find zones, all that cool stuff available here. Again, I've even got specific strategies on news, other types of strategies. I've got tracking sheets, all kinds of good information and documentation to go with it as well. If you got any questions, I'm always available, especially for my students, because you can see they can message me at any time. So have a great weekend, everyone. It's a holiday weekend, so I'll see you again very, very soon, I hope. Until then, trade safe, trade well, and take care, everyone.